Now we can turn towards refined products. And we're just going to start off with a quick summary in terms of kind of what is the total amount of demand that we've seen. And we like to average it out just because you can get a lot of lumpiness, especially with the hurricanes that have come through. You've had some storms. So there's always going to be this backfill. So if you think about how things move, when you know that there's a storm coming, you're going to try to get as much done as possible before everything shuts down. And then you have everything shut down. Then as things reopen, you try to backfill. So you're always going to kind of get this lumpiness. So when we try to streamline it and try to average it out, you can see that the average still remains in that kind of downward trajectory, which is, again, just to kind of talk about where we think things are going. That's why we're having that normal kind of trend lower, which it should happen now. Like we're in that shoulder season. We're in the point of where demand starts to dwindle lower, and we're just seeing that here. So even though we did have distillate have a big increase, everything else kind of either went down a little bit or kind of stayed flat. So that's where we're starting to see this downward move, but again, trying to account for that lumpiness. And when we look at distillate overall, you can see that we did have a nice draw of about 3.36 million barrels, which was really driven by pads 1 and 2. Now that pad 2 coming back to the refinery hiccup, that's something that it means that there's just going to be more pulled from storage there. Pad 1 or the East Coast had another draw, which is nice to see. It's just going to be a matter of kind of where do we sit going forward. The bigger problem is when you look at overall storage on a historics, you can still see that on a seasonally adjusted level, we're still at those all-time highs. Drifting lower, but we're still getting there. The question now is going to be, when does heating pick up? Is it going to be October? Is it going to be November? Where do we start to see kind of those heating demands? Because, based on what we're seeing in Europe, we're starting to see expectations of a much cooler winter. Again, finger to the wind, it's September 23rd, and we're trying to predict what the weather is going to be in November and December. So good luck. But it kind of gives you an idea of kind of where that shift is coming. Now, the question is going to be going forward, what's going to happen within the U.S.? Where is that heating demand? Because diesel demand remains robust. We still continue to see some of that positive pull through, which we'll talk about in a minute. And it's just interesting to see kind of where we sit right now, especially when you consider that this is a big overhang on a global level, which we'll talk about in the third segment. And in terms of what's that going to do for pricing? And that's why we continue to see refiners reduce run rates, which is what we're going to talk about in this week's write-up that goes out to clients. So here is just a backdrop in terms of that distillate demand. Again, we're just kind of in this range. That's the one that we've been talking about, where we believe we're just going to kind of hang around that 5-year average. We had a nice spike because we did have a big move in trucking. We had a decent move in diesel demand from the trucking side. We did have a nice little spike in rail. So again, those are things that are going to help pull through some of that diesel. But we think it's going to kind of average back out, come back down to that 5-year average, which is just something to look at as we kind of go forward. Because again, prices and just inherent crack spreads remain depressed on a global level, which it just means that even though we have some nice demand here, it doesn't mean it's universal when we look at it on a global level, especially as we have renewed COVID increases in Europe, which we're starting to see some lockdowns. We're starting to see trends change in terms of what's happening with their consumption, which is something we're going to talk about in our economy show coming out tomorrow. So here's just, we talked about the trucking. We had that dip that we saw last week, and we kind of expected it to kind of hang around that 96 to 98 level. We did have a increase back to 104, so we took out that high. The reason why we've been saying that we're going to kind of hang around this level and we did have a nice surprise to the upside is really looking at that truck availability. So you see here that we got down to that low, which is when we pulled the demand down. And then you had the availability come back up, and that also spiked when you saw that demand coming. So again, it's just coming to where is the demand? How is that pulling through? And when we talk about the PMI data and some of the other data in the econ show, you're going to see that this is going to be a relatively strong continuation. You can see here the rates continue up. They've maintained their bullish move. And again, the benefit of those rates is it's not really being driven by diesel prices because diesel prices remain low. It's really being driven based on the demand that we're seeing. So we are seeing those diesel miles being consumed in the US, which again is that nice tailwind for some of that diesel demand. So now that we've talked about trucking, we can shift to what's happening in the rail side. So this is one, it's a little bit delayed, but we have seen a turnaround. Still things are still down about 15% year over year, but there are some bright spots and it's going to continue on the grain side. So grains, we still have a big export movement. It continues. We just had another one come through for corn going into China. We actually saw Brazil importing from Uruguay just because they continue to see a huge export market specifically into China and to Asia. And that comes back to our last show from last week where we really talked about India, China, and just food inflation and what's happening in the food market. And you're seeing that play out here with grains. Some of the other benefits, we did get some price cuts in iron ore, some of the other metals and metallics, and just kind of these raw materials, which hopefully we'll start to see a little bit of a tailwind as some of those prices come down, getting some guys taking advantage and purchasing. So intermodal has started to recover. We continue to see some of that recovery, especially as we have some of these supply chains moving. We see the PMIs have been relatively flat month over month, but still in an expansionary level, which is going to be supportive of kind of intermodal. But again, it's still down, but it's still a net positive for diesel when you think of it week over week as we get some of this movement higher, which will be driven on the back of grains. Now shifting into gasoline, you can see we had another nice draw from gasoline of about 4 million barrels, and it really was driven again by Pad 1 and Pad 2. Pad 1, that's why we now include the import level because we saw imports come down 309,000 barrels a day. Again, it's going to be timing delays. We still have some more shipments coming from Europe that will show up on the East Coast. It's just a matter of when. We're getting towards the end of September. We think based on what we're seeing, they're going to show up this week and next. And then, we still don't see much coming in October. But again, it's still a little early, so we're going to have to wait to see how that shifts. And then Pad 2, again, that was just the refinery utilization rates coming down, pulling more from storage. But when you look at overall storage, we're now moving in the right direction. We're back within that cloud level. We're back to essentially the least amount of gasoline we've had in storage for 2020, which is again is a positive. So this is where when we talk about the numbers overall, this isn't a bad backdrop, especially as we're starting to clear through some of the glut of refined products. It's coming at the feet of refiners not being able to run at where they would like to operate on a utilization rate. But these are some of the benefits in terms of just trying to clear some of this glut out. And then when we talk about the glut, we have to look at what is happening on the demand level. So we figured that we were going to kind of go sideways. We had a little bit of an increase, but we think that the sideways move is just going to give way to kind of that normal projection lower. Again, we're still at this level of, this kind of flattish, let's call it a ceiling, where we really hit that plateau. And as we see some increases in COVID in New York, we see some issues overall. We're starting to see a little bit of unease or this concern in terms of travel. And obviously, kids going back to school, how does that impact parents? That's something we're also going to talk in our econ show and a little bit later when we do a deeper dive on some of the recent miles driven. Here, jet fuel demand remains flat. There's not much to say. Jet fuel has now priced itself where it makes sense to put it back into either the distillate cut or the gasoline cut. It's right on the cusp. So we're depending on where you are, what your margins are, what your demand levels are, you could see some of that switch. Jet fuel just remains kind of this lackluster, just kind of pushed to the right. And we're going to see that again in the TSA data. And then in terms of what the flight trackers are saying, as some headlines coming across right now are saying that European air traffic is falling, just as we've had some additional lockdowns and some increases in COVID cases across the UK, France, and and Spain at this point. So here's just, again, passengers, it remains in our confidence range. We're talking about, about 550 to about 750. And we just think we're just going to kind of hang around in this level. So again, that's going to pull flights down. We've already seen flights coming off. BNEF does a really great job of looking at flights coming back and forth in terms of what was expected and what is actually going to happen in September and October. And this gives you a quick little snapshot. So we're starting to see some of those flights come down across Europe, specifically France, Italy, Spain. Again, just looking at some of these COVID increases. And again, we've talked about in the past, people naturally react to COVID now. You don't need this massive government shutdown. People, not that they're scared, but they're just going to shift their patterns. Do I need to go shopping this week? Maybe I'll just give it a week, see if things calm down, and then I'll go back to my normal routine. So you're seeing kind of these normal movements, but the one big place that people want to avoid is being stuck in a steel tube in the sky. And that's really what we're seeing with some of these adjustments in flight departures. And just a quote from BNEF that I thought was really interesting is passenger flights scheduled to depart in October from the 133 airports they track have been reduced by more than 25% since August 23rd. So just consider that in a month, you've seen that those cuts really start to run through. And the cuts are really due to weak demand as virus outbreaks continue to hit the industry. So that's why we continue to see some of these, the jet demand come down even more. We expect that to continue through October, which again is going to push some of this jet fuel and kerosene really into the distillate cut, into the gasoline cut, which would kind of increase some of that storage that, just is just a movement of jet fuel or kerosene from one into the other. And that's where we start to look at some of the slowing indicators. This is normally where we have the Google mobility data, but they're in the process of updating some of their algorithms. So we didn't have the data that we really wanted. We're always gonna check to make sure that things are coming back, and we'll include it once the data has been updated. So here you can see again kind of that plateau. We're a bit more concerned here because we're starting to see some rollover. It's not picked up as well here, but in our economy show coming out tomorrow, we go a little bit deeper on how it's really starting to appear in, of all things, Google searches. It's, Google, as people Google less, it usually, it's just because they're searching less, which means that they're not preemptively looking to see how are they going to shop that week. So that's an interesting tidbit that we're going to talk about in our economy show. But we're starting to see that rollover in Germany, France, Italy, which is going to pull back down. And again, within the US, we continue at that tight level, which is just going to be that overall hindrance on just global refined product demand, which is just going to lead to an overhang in oil demand overall. Honing in a little bit more on U.S. gasoline demand, here you can see on September 20th, you can see that we essentially were flattish versus the week prior. It was up about 0.02%. So again, it's coming back down to kind of this plateau of just we're in this kind of flattish move, and we just think that we're going to start to see a little bit of a rollover as we have some resurgence of COVID. Again, not that people are going to have these huge furloughs or these additional lockdowns. Just people are going to look at this and say, maybe I'll just hold off from an extra shopping trip just to avoid additional exposure. So again, that's kind of where we see as this flattening out. And I think, Gas Buddy does a really good job of just kind of highlighting where things are week over week. But again, when we talk about gasoline demand, we have to think of, well, you had a big pull from gasoline storage just because you had to backfill the system. And then that's looking at from the refiner to the rack. And this is looking at from the pump to the consumer. So again, just looking at kind of two different parts or pieces of the supply chain to kind of marry it to put it together. Overall, the Department of Transportation does a really good job of trying to highlight this. Again, it's delayed, so we have to kind of marry where things are going, what we've seen. And here you can see that this is looking at July, and you can see that the trends continue to be negative. And it's just an interesting thing because July, August are supposed to be these big increases in travel. Now, August will be better than July based on what we've seen, based on what we've been talking about on the show. But it's important to look at the hard data to understand, okay, well, what is the estimate? So let's just take the cumulative estimate for the year is supposed to be about 1.6 trillion miles. Now, that might seem like a lot, but let's put it in context. Okay, what was 2019? 2019 was 3.27. 2008 was 3.2. So you can see the huge loss of miles driven, which again is being reflective, and it's not equal. If you think about who is being impacted, the Northeast is being impacted the most. As you can see that they're down about 15%. That will get better for anybody who is driving up to the Cape or further, or just driving to the ocean for vacation. You can see that there was more traffic. Things did normalize a bit, so August will be better. But again, it's just showing that trend is continuing, and we're down by about 11% overall, which is something that we think is going to be relatively consistent and will increase as we go through October. And again, this is just looking at cumulative. So looking at the 12-month average, you can see that drift lower as we continue to shave those miles off. And here you can see year to date just how different we are versus 2020, 2019, 2018. These are going to be the overhang for gasoline demand, which again, even though we're starting to see some of it come out of storage, it's because supply is coming down and we are seeing a little bit more demand, but that's something that we also believe rolls off overall. And this is just an idea of why. Like when you look at OpenTable, you've seen some of the movements shift down. Again, it's how long can people sit outdoors? What does that seating look like? We've seen some adjustments in terms of official lockdowns where restaurants or pubs have to close a little bit earlier. These are things that are just going to kind of impact how are things moving. Again, it's not enough to send us to these lows of negative 60%. But it's enough to kind of keep us in this confidence range of down 40%, which is something that we've been talking about for the last couple of weeks. And here you can see like who is driving that. And realistically, we're starting to see a little bit of a rollback in Europe. Again, it's weekend versus weekday, so you have to factor in timing. But we're starting to see a little bit of a rollback in terms of kind of where that sits as people opt out of going out to eat just based on COVID, some concerns around there. And here you can see the U.S. again kind of sitting at that, things get better during the weekend where we're only down 37%. Then as you go through the weekday, to that 45, 51%. So that's why, we're confident in saying that on a global level, that 40 to 45% is going to make a lot of sense as we kind of go forward, which is something we're going to talk about in terms of in the Econ Show. What does that mean for closures and jobs and that overall economic impact? And then we wrap up with just looking at the MTA entries. And here you can see things are starting to drift a little bit higher. We're starting to see some more movement back into the city. Again, if anyone who's trying to drive into the city on the LAE, there is more traffic, there is more congestion. So people are opting a little bit more for that, for subways. But again, you're still seeing people avoid mass transit overall just to reduce their exposure. So it's just something to track. The 7-day continues to shift higher, but it just kind of shows that people just aren't moving around as much and that work from home is still really key. And now that we've kind of looked at refiners overall and refined products overall, now we can go into, well, what does the global market, export market really look like, especially going forward over the next couple of weeks?